right, we'll kick this premium video off with a quick review of the VX. Now the VX, as many of you may know, has fired off a squeeze. Now the squeeze is not the reason we're long, although it's terrific confirmation for some bullishness that I'd like to see in the direction of the trend that was. So the correction is not the trend, right? We had all of this in here, which was very bullish. This becomes sort of a neutral market in here as the market consolidates, and then what we're looking for is a continuation of the overall uptrend. We're looking for this market that corrected, consolidated to move back up. Now the VIX would typically be, the increase here would be very much reflective of an expectation that I have for the market to move back down. So this is something that works for me on a lot of levels, and that's why we have our VXX calls. If you recall, we have our VXX, and for those of you that are unfamiliar with that position, this is the June 1942 calls, and we have 60 days to expiration, okay? And that's one of the positions that we took on the pullback, the initial pullback into this wave, which instead of pulling back and bouncing, pulled back and consolidated, and that consolidation on the VX is what finally gave us our squeeze, which is terrific news for us if we're looking for some bullishness. Now, for those of you that are unfamiliar with something I call the squeeze retreat, I did touch on that in the free video, but I do want to touch on a little bit more of what the retreat is. So the general idea of the setup is let the momentum of the squeeze, give us all that bullishness. We will not buy calls into that bullishness, but rather we will wait for the market to pull back. Now, this also presumes you're not already long. Of course, we had this opportunity in here, and we had all of this in here to focus on the lower half of the wave. In other words, this section of the wave between the 34 EMA on the close and the 34 EMA on the low, or the yellow and the red lines. That's the lower half of the wave. So if you didn't already buy on the correction, if you didn't buy in the lower half of the wave, this is the third opportunity, kind of the last opportunity, but we want to wait for the retreat. So that means we head on over to AutoChartist and we look at, for example, the VXX and say, all right, what's a typical daily price movement range average to high? So ideally a retreat that would be sufficient in terms of bearish momentum, giving us some weakness to buy the calls in, and being a measurable quote-unquote retreat for us would be 2 to 4 points. So the moment the VXX trades down 2 points, we've got the opportunity then to look at calls in the VXX. And again, I'm looking at those June 19, and the 42s are fine, the 42 calls, all right? So that's a squeeze retreat, and that's the way that I play squeezes every time. Let the squeeze fire. I will not enter with the bullish momentum. I will take the chance. This is going to be one of the common squeezes that fires off and then gives us a couple opportunities to possibly get back in. And that could be, for the life of the squeeze during its momentum period. Not everything goes straight up. Now, there are going to be those exceptions. But again, as a rule, I do not want to be buying calls in an up market. Squeeze retreat is how I use that terrific signal and then adapt for my specific trigger. Okay. Next up is taking a look at our intraday. We're going to go transition to our intraday look at the market, and specifically at the way in which this market responded to the gap today. Now, as a general rule, when the market is looking bullish, what I want to focus on is the long side of that, either the NQ or the ES. So when we're looking at the long side of the market, we want to focus primarily on the two bullish indices, NQ and ES. All right. When we're focusing on the short side of the market, we want to focus, by the way, on the Russell and the Dow. So think about that. So a little favoritism directionally to the bullish side of NQ and ES, bearish YM and RTY, and that will apply even to the day trades, right? Clearly to the end of day trades where we have our trade of the week from last week, IWM, and I like the bearishness in the small caps. I like the short in the Russell. So we have a gap down. Now, much like limit downs, gap downs tend to attract a lot of bottom pickers. They tend to attract a certain amount of bullish momentum because folks feel like they want to what's known as fade the gap. So in a gap down, a fade would be a buy. Now, rather than just jumping into the market long as soon as the bell rings, what we do is we wait for some clarity on momentum, which means we wait about 3 minutes. You can wait up to 5, 3 to 5 minutes for the range to present itself. Now, there are some bullishness, aggro bullish players that will take the first 1 minute of the day, and if that first 1 minute high is taken out, they're long. If that first 1 minute low is taken out, they're short. I find that entirely too twitchy, so I will wait for the first 3 to 5. 3 is really a pretty good number. So let the first 3 to 5 minutes establish your high-low, right? 1 to 3 is kind of aggressive, and I'll monitor that. 3 minutes is kind of my sweet spot. 5 minutes. The reason I bring up the 5 is it aligns with our clearing range tool where we have a 5-minute breach selection in the drop-down menu, which means that we can choose how many minutes the tool is counting down to give us indication of whether we've taken out the 5-minute high-low, 15-minute high-low, 30-minute high-low, or 60. So there are within the members area a couple different clearing range tools. There's a Waikiki and there is an FMB. Okay, either one of those are fine. When you open them up, they're typically both going to default to 5 minutes, which for now is fine, especially if we're opening up to a gap or dealing with limit moves. But normally in this environment, I have been sticking with the 60. The 60 is going to tell me my initial breach high-low, the 60-minute high-low. But specific to gaps, we want to go over the 5. So whether you're using the Waikiki or whether you're using the FMB, the nickname for the clearing range tool, the nickname for the tools come from the members or the people who have coded this for me. So if I have a process that I follow, a lot of times people can say, Rog, I can code that into an indicator. I've always been very transparent about my tools. And so some folks will say, look, I can make that a whole lot easier for us. And that's what makes our community so great. We have a lot of generous folks who are taking the processes that I use and saying, look, we can shorten the learning curve for folks. Rather than them having to watch the first 5 minutes, this is going to do it for them. Terrific. So what do you have? Boom, long trade triggered. What does that mean? That means we have taken out with that vertical line, with the candle that's associated with that vertical line, we've taken out the 5-minute high. That's going to be the momentum coming out from the gap down. That's the direction, at least for the first half of the day, for at least about the first 45 minutes, minimally, that I will expect the price action to go. Now, the probabilities are that will be the favorable side. This went far, far higher for far longer than I anticipated. Excuse me. If I can get movement to about 10:30 in the direction of that 3 to 5 minute Momo breach, I'm tickled pink. This one worked for 2 hours after the open. So what we want to remember is that ultimately what we have is a long position triggered by that overall movement through that 3 to 5 minute high. And a couple members have said we could add the 3 minute in there, so we might have yet another clearing range tool to account for some of these gaps and limit moves in the morning that we were getting on the open. So that's the way in which we treat the morning. And I'll tell you, for most traders, if you pretty much wrap up your index day trading, your S&P YM, RTY, and Q by 11:30, 12 o'clock Eastern, that really is going to be, those first 2 hours, 2.5 hours a day, really are, I feel, and probability-wise, and also just, I look at my own track record, it's far better trading the indices in the morning to about lunchtime, to about what we call the midday or lunchtime doldrums. The remainder of the day does present opportunity, but I think the cleanest trading we're going to see is the morning. Now, The rest of the day, today was difficult because even though we did have an initial balance breach to the upside, the VWAP did not hold. Once it did not hold, you saw the yen strengthen, you saw bonds strengthen, you saw the Australian dollar weaken, and then all of a sudden the market just started to sell off, which overall for our longer term positions, the alerts that I've been sending out over the past couple of weeks, that suits us right down to the ground. I mean, we want to see this market move lower overall. I'm not rooting against the market. I'm rooting for the market cycle. I'm rooting for the market trend. I'm rooting for the data. I'm rooting for what logically would make sense in this environment aside from what the Federal Reserve and the Treasury are doing. That's the only reason this market is up. That's the only reason. You know, we saw the oil shock today. Realize that if we had seen this in any other environment, right? If we had seen this in any other environment, I think the Dow would have been down 1,500 points. That's nothing for the market nowadays, right? And so one of the things that we have been in for a prolonged period of time is bearish energies. This is not a new position for us. One bit. I don't know who would be long energies. For the life of me, I really don't know. I do want to remind everybody what I mentioned in the closing session is this was a unique to the May contract phenomenon. A reason number 403 that we talk about getting out of the front month about 2 weeks before first notice date. I may not even wait for the roll date, right? But remember, this was not the contract with the open interest. The market had moved on. So this is, 48 hours from the end of the contract. Again, a lot of folks ask why. There's a lot of reasons I think that we could hypothesize, but let's face it, this is a historic move. So let's not act like we know exactly why this happened. There's probably going to be some funds that are blown up. There might be some companies that are blown up. There's certainly some ETF. All these 3x ETFs are probably going to exacerbate it. There's nowhere to put the stuff. One of the things that I'm very curious about is a long plastics play. Seriously. So we'll talk about that tomorrow. But this is an overall downtrend. I'm not saying that suggests that crude would go negative, but we sure as heck didn't want to buy it. And where else are we positioned? As we cast a wide net in our overall bearish play on crude that's been open for months, XOP and XLE. All right, so I'm looking for follow through in those two names as a wider play on this particular trade. Now, could June go the way of May? I'm not ruling that out, but I'm also probably as happy about being short as I've been, but I'm also slightly concerned because what's next? Treasury's going to start buying oil and oil notes? I mean, really. So we have to be a little careful now. I'd like to see some follow through. Remember that the lows that we've put in crude, for those of you that are short the June contract, the lows that we've put in crude are at this value area low for the month of April and this Darvas area. And we've had a very difficult time for the month of June to break 20. Not that it's impenetrable, but that in May I kept talking about an $18 target. Clearly I didn't mean negative 18, who knew? But I still have a lower low target for crude, but we are also playing XLE and XOP. Speaking of energies, let's talk about natural gas. Natural gas, once we started printing these green grab candles in here, we knew was not going to be the same downtrend that we had enjoyed for most of the end of last year and the beginning of this year. Once the green grab candles appear, the overall downtrend is no longer indicating a beautiful red like we had for so many months. It's more choppy. But it doesn't mean that I ignore the trend that was. It simply means that we know this market's behaving a little bit more range bound, and to get lower lows might be more difficult. I am looking at lower lows. We've had many successful shorts in natural gas, and tomorrow I'll be looking for yet another set of puts in UNG. But let me talk about this candle here. This is what we call a reaction candle. I don't know why I call it that. I just call it that. And what that means, it's a larger than normal candle. Just happened to be up. Larger than normal is larger than the typical daily price movement range. Okay. Now, when that happens, it's not unusual to get a minor low pattern get put in. And if we can get that nice, quiet, squat-bodied candle that even if it puts in a higher high, preferably it puts in a higher high with a slight bit of bullish momentum, that'll give us exactly the opportunity we want to buy those UNG puts. And I'm going to go right back into the same contract that we played before very successfully in natural gas, playing those UNG puts, and that's the July 17 contract. We'll take a look at those 14 strike puts, and that'll be tomorrow. Now, the risk in playing the puts today, it's not a huge amount of risk, but, well, I shouldn't say that. We don't know what tomorrow would bring. We don't know if this market's going to skyrocket again with a similar size candle. I don't believe it will, but who the heck knows? We've seen, gap, big candle, big candle, big candle, another candle putting in the minor high, big candle, big candle, big candle, right? So it's not unusual to get another one or two of these, which is the risk. That's the risk. By waiting for the minor low, you minimize the risk, but you're still able to take advantage of the opportunity to buy your puts at the bid for that 14 strike. That's the advantage that we want, okay? So that is what we're looking for in terms of another short. Again, this will probably be what, our fifth or sixth short over the past 3-4 months at least. No, more than that. In natural gas. Again, I like the overall move, but this is not the same downtrend that we were shorting even earlier this year, okay, through January and February. Things got bumpy in March, and they remain bumpy into April, but I'm going to keep that bearish bias. All right, moving on to gold and bonds. So do I want to be long gold? I do, but I want to pull back. That's going to take me a little closer to 1650. I haven't ruled out the value area low around 1670, but I need something to pull back, preferably into the wave, before I get long gold. Now, the ideal scenario is we get a much deeper pullback. I'm not going to rule out that if we get a big sell-off in equities, we may not see another gold liquidation in order to meet margin calls. That would suit me just fine on multiple levels. We have mostly a short book when it comes to stonks. We have a bullish bias in gold that's been in place since Q3 of 2018. We have a short GDX position, which is an aggro play on the fades at 17, right? And everything would just kind of come together with a few days of weakness. Not even a few. Two days of equities weakness. Maybe an oil shock follow through, and then we could see some weakness in equities, maybe a liquidation in gold. I mean, these are things we've seen before. I'm not hypothesizing things that we have not seen, okay? So that's where my head is at with gold, and of course, gold heads down lower. Let's just get out of that GDX position and be done with it, and start to think about the position that I really want, the position that's one of the top 3 in my longer term portfolio, along with dollar and bonds, and that is gold. All right, let's talk about the ZB bonds. We have our long position in TLT. I have no interest in not having a long position in TLT. We've got a little bit of follow through here, which suits me just fine, but I'm looking for movement back up towards 183, and that's going to carry our TLT, our long ETF position, into the first profit target again. Now, if you've already taken this target before, don't do it again. We want to see the market get above that. But this is a trade that I really like. It's one of my largest portfolio positions. It's one of my favorite markets to trade. My bullish bias is strong. So rather than saying, don't fight the Fed, how about trade with the Fed? And this is the best way to do that. All right. So this is what I've got going on to kick off the week. Quick review of the day trades. We'll talk about the day trades again tomorrow when I'm live with you in the room at 9:20 Eastern.